First thing we're going to talk about today is SPACs. These are special purpose acquisition companies. We have an article here from CNBC. They used to be a joke in Silicon Valley, and now they are going mainstream. So the reason this is coming up is because venture capitalists have pointed to SPAC announcements by SoFi, 23andMe, and Desktop Metal, these are all different companies, as a clear sign that higher quality companies are choosing that route to the public market. Now, what does that mean? Let's break this down. I want to talk a little bit about what special purpose acquisition companies are and what they mean for you as a potential investor and what they mean in terms of just getting more investing knowledge. When a company goes public, that company has the ability to take its ability to raise funds essentially from the public. What does that mean? The public markets. People like you and me who have brokerage accounts by Robinhood or E-Trade or TD Ameritrade, whatever it is, and we can upload I said upload like it's content. We can upload our money from our bank of accounts, transfer it into those brokerage firms and buy stocks. So Facebook is a public company, right? That means that Facebook has millions of public shares. That means Zuckerberg owns some shares, the board owns some shares, institutional investors own some shares, but the majority of the shares are owned by the public. That means public investors like you and I can all buy one share of Facebook. Why is that beneficial to Facebook? Because the value of a company is determined through the share price, essentially. That's why in like sort of mainstream, like really rigid capitalism discussions, the only thing you should care about when building a company is shareholder value and shareholder maximization. And that's like how much bottom line is going back to the shareholder to increase the prices for the shares they're holding, because that keeps them investing in the company. Things have changed. Now we're more in what Mark Benioff likes to call, he's the CEO of Salesforce, which is like some $200 billion, cloud computing company. Stakeholder capitalism, which is caring about the employees, caring about the environment, caring about diversity and inclusion, all of these different things. So we're not really only in the shareholder mold of capitalism anymore, but nonetheless, the way you make money off public markets is the share price. So if you bought Facebook at $40, which is what I believe it IPO'd, which was the initial public offering, that is the price that is initially offered to the public to buy shares at once they officially get on a stock exchange. The most famous one is the NASDAQ. Or the New York Stock Exchange, I think, like kind of the same thing. Basically, the big thing in New York where everyone rings the bell and there's like, oh, we're company's public. Then today you would be making a like 6x return, right? Because Facebook stock's like 240 right now. So 6 times 40 is 240. So that $40 investment in 2012 would have turned into a $240 gain in 2021. Not too bad, for 9 years. Now, if you bought one share, you would have made $150. If you had bought 15,000 shares, you would have made that times 15,000, right? Which is really, really the benefits of a company going public and you as an investor being able to make money off a company that's ultimately going public. That's what the traditional IPO going public process is. Now, special purpose acquisition companies are uniquely important because the way a company goes public has a lot of steps to it. Usually they go through an investment bank. You can't just like register to go public. They have a ton of different processes in between. And usually like Goldman Sachs or JP Morgan, one of these big companies, facilitates the process of taking the company public. I don't know exactly how they do it, but that's what they do. A SPAC company is really interesting because a SPAC company basically is listed on the stock exchange publicly. You can trade it, but it's listed as a special purpose acquisition group. And usually they're ranged from like $10 to $15, the stock price. When that stock price jumps is when that special purpose acquisition company merges with the company that's trying to go public, and then boom, that new company becomes the stock price of the actual company that's going public. So let's say Facebook went public through a SPAC. About 6 to 7 months before Facebook officially goes public, there would be a special purpose acquisition company that would be on the stock exchange. No one knows if it's for Facebook or not. You just are taking a bet that if you buy shares of that company and that is Facebook and it's supposed to open at 50, then if you bought it for 10, you made a $40 profit that day because that turns into Facebook, right? And that means it jumps the price up immediately. The goal of special purpose acquisition companies was to democratize the IPO process, right? And what does that mean? The IPO process is usually sort of reserved for hedge funds and big banks and stuff that like actually take a company public. And the only people that benefit from it going public through the fees and all this stuff are the banks that actually make it public. A special purpose acquisition company now is publicly traded, which means me as a consumer, I can buy shares of this not knowing what it's going to be. It could be a dud, but if it is, the Airbnbs of the world and it goes public, then that share price immediately jumps up, and I have now benefited, I have profited off a company going public as a retail investor, which didn't exist. It existed a while ago. It just wasn't a main thing, which wasn't mainstream 10, 15 years ago when companies were not going public through special purpose acquisition companies. So, reading from this company from this article, in a SPAC, a group of investors raise money for a shell company with no underlying business. That's the SPAC. The SPAC goes public, generally at $10 a share, and then starts hunting for a company to acquire. So that SPAC is now trying to figure out which company can we merge with, and usually, sometimes they already know this, before, and this is just the due diligence they have to do. When it finds a target and a deal is agreed upon, the SPAC and the company pull in outside investors for what's called a PIPE, or a private investment in public equity. The PIPE money goes into the target's company's balance sheet in exchange for a big equity stake. The SPAC investors get stock in the acquired company, which becomes the publicly traded entity through what's known as the de-SPAC, right? That's where everyone else gets the benefit from this. One major advantage, SPACs allow companies to provide forward-looking projections, which companies typically don't do in an IPO prospectus because of a liability risk. So basically, SPACs give the investors, the founders, and the public the ability to benefit off the company going public from doing future projections and from literally being able to buy shares of the potential company before the SPAC actually acquires the company that they're going to acquire. So I just wanted to bring that up because it seems like SPACs are becoming a lot more mainstream. If you just type in purpose acquisition groups on your brokerage account, you'll find a ton of them. And if you invest in them, those could potentially blow up to be, multi-billion-dollar companies if they acquire a certain company and then you benefit off the share price increasing. So I'm really getting interested in SPACs just because it is more of a democratization of finance, but I guess we'll see where it goes from here. I hope that helps you guys understand a little bit more about SPACs. It's a very cool name for it, SPAC.